Hello, and welcome to the Q1 Outlook with an almost full Saxo strategy team. Of course, the title of this Q1 Outlook is Fueling the Energy Crisis, which the team will take you through asset by asset. Of course, we in our camp is firmly believing that the problem we have right now is that inflation is structural, and underneath that structural inflation sits the fact that we are underinvesting into the capex of energy overall in terms of the green transformation, making things worse. But all these points will be taken from the team. Uh, as we have this seminar the day after the FOMC, I just want to spend 2 minutes before I hand over to the team on the actual FOMC meeting itself. As some of you may know, we have been in the camp since November 2021 that this is one of the single biggest changes in monetary policy in modern history. To illustrate that point, I think it's important for people to know the following. In all of the history of Federal Reserve, more than 100 years, there's only ever been two American presidents who've asked the Federal Reserve to hike interest rate, Jimmy Carter in the 1970s and Joe Biden. That information alone should dictate the framework by which you analyzed everything from here onwards. The practicality of this is that since 1998 and the LTCM and that put that was created at that time on the market, that's been alive and established throughout every single year until November 2021. So, in economic terms, the cost of operating with lower financial conditions, or in layman terms, lower interest rate, was free of charge because it didn't mean that we had an inflationary push behind it. So everything they did didn't have an inflationary impact. That changed in November 2021 in the eyes of the Federal Reserve, but of course, in the eyes of us as strategists and analyzing the market, this changed already way back in 2020 when we foresaw that this mantra that we've been carrying, that the physical world is too small for the fiscal stimulus, for the monetary stimulus, and of course the fact that we have a structural underinvestment into this, topped up by this ESG label, which makes the available pool of capital to facilitate the supply chain smaller. What happened and transpired at FOMC yesterday was a 100% confirmation of that stance from November, that we have a pivot by the Federal Reserve. Priority number 1, 2, and 3, and 4, and 5 for the Federal Reserve right now is fighting inflation. The transmission and the mechanism by which they're going to do that is what is called financial condition, a combination of factors that are all interest rate related. The bigger one, of course, being the equity market. So in order to fight inflation, the Federal Reserve needs to increase and tighten the financial conditions. That is actually relatively difficult. Over the course of the last 10 years, we've seen a drop of 500 basis points worth of financial conditions. And now they want to rewind back only 100 basis points. What we know is that 100 basis point tightening of the financial condition, everything being equal, should mean 20% sell-off in the equity market. So, of course, the balance that the Federal Reserve right now is trying to do is to be gradual in terms of its approach, and through that gradual approach, not scaring the market enough to have a sell-off which is outside the 20%, which seems to be the accepted tolerance for the Federal Reserve right now. The problem for the Federal Reserve, of course, being that they are chasing inflation. They don't have a preemptive policy. They don't have a policy which is ahead of time. Instead, they have let's try to go with it as long as we can and see if something breaks. And if you have that attitude that you're going to do it a fly by night sort of attitude to how you're going to operate this, of course, you will ultimately end up with something breaking. And that is essentially what the Federal Reserve meeting yesterday confirmed. It doesn't mean that you have to be overall bearish on the whole market, and the market is not having great pockets of value, which something that Peter will address in his take on the markets. But what it does mean is that you have to be a little bit more defensive, and you'll see a rotation probably overall that goes towards industries that are not cyclically impacted by this. We do foresee a slight slowdown in economic growth, but less so than other people. We come from a very high saving rate, so the ability of the actual consumer to withstand this is stronger. But that only means that in order to actually take inflation down, of course, the Federal Reserve will have to go the extra mile in terms of this. So overall, what this is, and the context you need to remember, if you only take one thing away from what I just said, it is that you have to remember this is only the second time in modern history that the Federal Reserve have been asked by the White House to go ahead and hike interest rates. And just for those of you who want to talk about the independence of the Fed, there are no independent Fed. The Fed is at arm length, an extension of the policy. The reconfirmation of Brainard and Powell was coinciding exactly on the day with the pivot by the Federal Reserve from transitory inflation to one that is now, in the words used by the Fed itself, entrenched at a high inflation rate. So we continue to see inflation coming, and this Q1 outlook will talk to the fact that there are two additional impulses that can make sure that inflation stays elevated. One is the second round effects, which is wage inflation, and the other one, of course, is the energy crisis and the inability of creating elasticity in this space. But with that, I'm going to leave it to the far better and more intelligent and far better looking rest of the team to take over from here. A little bit of about the day to day. After this intro, of course, you can, if you want, you can actually download the presentation itself directly on this new format. I think it's in my screen. It's on the top right-hand corner, so you can get the presentation almost immediately available to you. After the talk, and every asset class will be given 10 minutes only, we will have a Q&A session moderated by John Hardy, where you should feel free to use the question segment, which I see a few of you already used during this small intro. With those words, I'm going to leave the word to Peter Gondry and to take us through the equity. And I wish all of you a safe and good Q1, and hope to be seeing more of you. Thank you very much.
Thank you, Steen. We obviously have to show the disclaimer. That's how the world is these days. So we'll just let it hang there for 2 seconds and then not spend more time on that. Obviously, I'm going to talk about equities. And as Steen just put out, we are in a new era inside the energy sector. And but before we talk about energy, I just wanted to show you this. So on the right hand scale, you can see our right hand side, you can see our theme baskets. And in an inflationary environment, the market is actually telling you what is actually working. And the commodity sector, which the energy sector sits inside our commodity basket, is actually one of the only baskets that are up this month. And I think that really tells you that in order to get a portfolio that can withstand inflation, you need components that that could benefit during that inflationary environment. The long-term picture here you see in equities is the MSCI World Total Return Index. So this is your long-term growth rate. There are two things to take away from this. So the big jump higher in total returns from 2010 onwards was driven by the technology sector, and the winners typically don't continue to be the winner for the next 10 years. So you need to find something else. And in a high inflation, high interest rate environment, you will see a push down on valuations in some of these high growth areas. And energy is the one we're focusing on today. And I'll show you some interesting things about the energy. But the commodity sector basket, you can find it on the trading platform under the research tab, and then go to the stocks section, and then you can find our theme basket. You can find some inspiration there on our commodity sector basket. Another thing you should note from the long-term trend as well is that during the energy crisis of the 1970s with high inflation, you actually had pretty stiff pretty high, big headwinds for equities, as you can see there. We deviated from trend, and this, by the way, are in nominal terms, right? So in real rate returns, you actually had a decade. Some people call it a lost decade from 1968 to 1982. You actually had close to zero real rate returns in U.S. equities. So this is worth keeping in mind. And one of the things that have happened with energy is that from 1995 until 2008, at the peak in June 2008, when the oil price hit $140 per barrel, you had the global energy sector delivering 7.5% alpha annualized over that period. It was driven by China. They saw their energy consumption go up massively because of urbanization, because of globalization and the introduction into the WTO. They basically became the world's factory, and because it was a very less energy efficient economy, they needed a lot of energy to deliver on what they were handed by the world. And the way I see it, I think Sin and I had a conversation about it. It's almost like we were given an energy loan over a couple of decades, and now we have to pay back that energy loan. And we had, I'll show that on the next slide, but we had a lot of investments that for a time gave us a lot of cheap energy, and that thing is changing right now. So, and from 2008 until just recently, we had a massive big slide. So at the peak in June 2008, the global energy sector peaked, being around 16% of the global equity market. As of December 2021, it was only 2.7%. It's one of the smallest sectors in the entire world, and that's despite the world is running on energy, and we want to electrify and create green, a green transformation. And in the outlook, I write some different pieces. So if you look at if you look at the global energy sector right now, it has a dividend yield of around 5%. On top of that, you have buybacks, so that adds to that yield. And if you look at the dividend growth since 1995, it has been approximately around 5%. So if you add all those things together, your expected return on a global energy portfolio is probably somewhere between 10 and 12% right now. I think with inflation and rising interest rate, I think it will be very difficult to find an asset or sub asset in the world that can deliver 12%, especially with inflation. That is why this, getting energy and commodity exposure in general, because that's also the takeaway from my long-term chart, is that I don't think a lot of people in the world are very good at timing the market. It's a super difficult thing to do, and even if you get it right, getting out, your next headache is when to get in, and that is equally difficult. So you have to do two difficult things in a sequence to get it right. So for most of Saxo clients, I think the a better approach is to think about equities as a long-term asset class with a drift. But right now we're changing into a new regime, so you need to find the drift components elsewhere, and energy is exactly that. And one of the things why we think energy will deliver very high returns going forward, and this will be my last slide before I hand it over to Ole, is that we have capital expenditures, both in real and nominal terms, hitting some very, very low levels, some of the lowest we have seen in multiple decades, and I think you can see it here. And the expectations we're getting right now from the oil and gas majors is that they not increasing their capital expenditures for 2022, and that's despite an oil price at $90 per barrel, exactly where we were around 7, 8 years ago. And as you can see, the investments level have come down. And I think one of the key things to remember, and why we think actually that commodities could rally over many years from now, is that if you look back at the chart here in 2000, that was when China became a net importer, net export of commodities to being a net importer. And it took 4 or 5 years before the global mining and energy sector really ramped up capital expenditures. And by that time, the price had already doubled, and they were constantly behind the curve on expanding supply. And that's also one of the things that you have to keep in mind here, that the physical world operates with a very different elasticity than the digital world. You just cannot crank up supply very easily. It takes a lot of capital and it takes time. And we think that there is a massive urbanization going on in India right now. India is growing very fast. It will soon add to China's demand for energy and resources. On top of that, you have electrification, um, air to heat pumps, electrical vehicles, all these things, and you have the green transformations. All of these things will require a lot of energy, a lot of investments in metals, require a lot of metals. So we think the energy and the wider commodity sector, being metals as well, will do extraordinarily well over the coming decade, and should be a cornerstone of your portfolio in equities. And I know it doesn't sound very ESG, but the way I see it, you have to sin a little bit in order to get into the green heaven, if we ever get there. And I think it will be one of those very critical questions that politicians will have to deal with, and also you as an investor, that you could get away with ESG positive portfolios, which has a tilt into technology. But what happens if a lot of the alpha that will be generated, what happens if that is suddenly in all the non-ESG parts of the market? You have to you have to take a stand on that as a portfolio manager, because if the alpha goes there, what do you do if you want to do continue to only do ESG? So that will be one of the hard questions. But as a private investor, you have the luxury in not being constrained by ESG mandates. You have much more flexibility in your portfolio. I think you should take advantage of that. And I think with that, and I'm happy to answer questions in the end. I'll hand over the word to Ole on commodities.
Thank you very much, Peter. Good afternoon, everyone. I believe you can see my slides. I'll be just watching a little bit to the left here, so that's where my slides deck is located. So we come out of more than a half a decade of almost non-action in the commodity space. It's been a half decade where we had ample supplies, just constantly keeping prices in check, keeping the investment demand at a relatively low level. But that has obviously changed quite significantly since the pandemic struck in the early 2020. On the slide here, you can see the recovery that we had in the Bloomberg Commodity Spot Index has just been phenomenal. This has taken the other days at 534. Now we're at 540. Closed yesterday, and today with Brent above 90, we're probably even higher. So we've seen almost a doubling of the commodity, this commodity index, which is basically reflecting the price development of 24 major commodity futures. What is driving it, and why do we see this continue? This rally continue over the coming quarters? Is basically as some of this what Peter's mentioned already. We got demand recovering very strongly after the pandemic, with a lot of injection of capital into the system by governments and central banks, making the market very tight, because there is a limitation to how much the market can absorb, or how much before if we start to run into tight supplies. We're seeing that already now. We have weather impacting grains or the agricultural space. We've got ESG, which has been mentioned as well, capping investment appetite across some of the major key areas like mining and oil production. The super cycle thing on that basis is still well and truly alive. I'll just highlight some of the main reasons that drives a super cycle, and as you can see, we got several of those playing out right now. Probably one of them that is not really happening is the dollar. We are seeing we're seeing the relative dollar strength during this rally. John can talk more about the outlook for the dollar, but so even though we had a dollar strength, we've seen this phenomenal rally in across commodities. How long will it last? Well, it basically lasts as long as it takes for supply to catch up with demand. Demand is imminent, is immediate. Supply is much more inelastic, especially when it comes to mining and oil production. Adding to that, we have the old saying that the best cure for a high price is a high price in commodities, because it incentivizes increased production. At the same time, it also kills some of the demand. Right now, with the ESG becoming having a much more greater impact, we may not see that production response that we have seen in previous periods where we've seen surging prices. So that's also one of the reasons why the underlying trend still points towards higher prices. Those higher prices are being reflected in the market structure in the futures market right now. I'll try to show this by taking the 1 year carry. This is basically the spread between the first futures contract and the 12 months contract for 12 months out. And the bigger the plus, the bigger the front contract is trading above the contract 12 months out. That is so-called backwardation. Backwardation is a sign in the market of tightness. And as you can see here on this slide, we have the dark blue line is where we are right now with some of these commodities. And you can see almost across the board, we have returned to backwardation, whereas a year ago, a lot of these commodities were still trading in what we call contango. Why is this important from an investment perspective? Well, it is. Just think about crude oil, for instance. Take crude oil, the second one from the right, CL. The roll yield there right now, or the difference between the spot and the 12 months, is currently around 11%. That basically means that even if you are today sitting here expecting that crude oil prices in a year's time, at a minimum, will be unchanged compared to today's levels, you would pick up a roll yield of around 11%. If the price then on top of that, the spot price on top of that goes even higher, then you can add to your potential return on the market, on this market. And this is why we have seen quite a substantial increase in asset managers starting to move into commodities, because following years of oversupply and contango, where you actually were paying money away every month to be long in a market that wasn't really moving, now you're having the tailwind from the kind of backwardation, which gives you a positive roll yield every time you get out of an expiring contract at a higher price and where you buy the next at a lower. That is reflected if you take the average, simple average of these markets. You can see that the average roll yield on a basket of 23 commodities, I've excluded natural gas and some of the meat contracts, then the roll yield right now is the highest it's been in decades, more than 5%. And that is really one big incentive for investment, but also a reflection of the tightness that we're seeing in the market. Money managers are big participants in the commodity space. They are reflecting. They are acting on the momentum and breakouts and the general macroeconomic outlook. Right now, there was quite a bit of a reduction in length during last year. So that basically means that if we are seeing renewed price increases here, there's plenty of room for managers to increase exposure, and that will obviously have provide an underlying demand for the market. The energy sector remains the space, the sector where we see most of the tightness, at least here in the short term, but probably also even longer than that. We have just broken above $90 yesterday in Brent. Looking at the long-term chart here, we can see when we broke above 85, the next major level is not really before the $100 mark. And with the current momentum, that seems like the direction we're heading. Also, just looking at this tightness that we're seeing in the market, a very, very elevated spot price compared to even the next one, and that does indicate the market is scrambling for barrels right now. Where can additional supplies come from? Well, it has to come initially from OPEC Plus, but OPEC Plus in December, they were struggling. 14 members out of the OPEC Plus group, which is I think around 24 members in total. 14 out of those struggled to meet their quotas. Even Russia, which is currently trading, producing 250,000 barrels below their quota. This is a clear reflection of the lack of investments that's coming into the market. So even though we think that OPEC has X amount of spare capacity, we can see how the difficulty in actually getting that spare capacity translated into actual barrels hitting the global market. So we need to look for barrels elsewhere once the spare capacity in OPEC runs down. That could be from U.S. crude oil production increase. They are still 1.6 million barrels below the peak in late 2019, but they have become much more disciplined, and that growth will probably only happen very slowly. Iran could be the low-hanging fruit for President Biden, basically reducing or removing the sanctions. That could provide an imminent boost to production. The question remains if that can be seen. And then just an example of some of the OPEC Plus producers, how they're struggling. Nigeria, Angola, and Equatorial Guinea, they are producing more than a full month of quota increases right now, and there's not any outlook for them being able to increase production anytime soon. So the outlook for crude oil, with this in mind, most certainly points to higher prices over the coming quarters. Gold market was a disappointment last year, but then not surprisingly so, because we had low volatility. We had very strong stock markets. We had inflation worries that were mostly viewed as being transitory. Heading into 2022, we have seen real yields spike by more than 50 basis points. We have seen gold hold trade close to unchanged on a year, even after yesterday's announcement. It does indicate that the market, gold is starting to attract some renewed demand. And if you're an asset manager and you're sitting on gold this month at flat performance, you will be very, very happy compared to what's been going on in the bonds and in the stock market. So we think that even though real yields will continue to move higher, there will be a focus on other areas as well at the same time, which over time will provide the enough support for gold potentially to break that downtrend we've been in for a while now and start to move back up towards the $2,000 mark again. I just put copper in here as a representation for the industrial metal space. Probably something like nickel and aluminium might even have a greater upside than copper. because of the outlook for increased supplies, at least in the short term for copper later this year and early 23. But nevertheless, copper has withstood a significant amount of pain or worries in the past 6 months, especially with China and the property sector. And despite of these worries, copper has managed to trade sideways. That does indicate to me that we have an underlying strength in this market, but we just need to see the market break. So far, we haven't seen that, but just a small pickup in additional demand is potentially not going to be met by stock levels, which are, as you can see here on the chart, which are at the lowest point that we've seen in a number of years. Speculators are holding a very small position in copper, so plenty of room to increase positioning if we start to see the breakout. Just a slide, just to give an idea about the green transformation and really why it's so important that we continue to look for mined materials, and we also continue to look for raw materials in general. This is paramount important for the green transformation to succeed, and with the obstacles being put in the way, there's really only potential one direction for many of these prices, and that is towards higher levels, which to a certain extent can incent or can reduce demand in certain areas. But as you can see, it's almost every single of the major metals are needed in its green transformation, and that's why we maintain a bullish outlook for the mining sector, for the industrial metals as well. There are plenty of different ways to address the investment into these. I suggest you take a look at the outlook. Peter has highlighted a list with names that could be interesting in this sense. So take a look at those. And I think with that, I will stop here and pass on the mic to John Hardy for the FX update.
All right, thank you, Ole. Hopefully you can see. Yes, you can see my slides. And yes, so my area is FX. And in FX, we just saw, of course, last night's FOMC meeting with the hawkish surprise, mainly in the press conference. I think Powell mostly wanting to express the reluctance to provide forward guidance. This is the biggest shift. I mean, Stain mentioned this is the biggest shift really in Fed history, going back to Carter, this being only the second Fed that has had a major mandate to get on top of inflation since Volcker was appointed by Carter back in the 70s. But you're also seeing a shift in the sense of they don't want to provide this forward guidance anymore to the degree that was established under Bernanke. Greenspan was always trying to keep things mysterious as possible, having this mystique around his when he was at the helm of the Fed. I think Powell not wanting Greenspan type mystique, but wanting to keep the potential for what the Fed is going to do very open, whether it needs to soft pedal things if it somehow engineers a market crash, or to actually hike far faster than the market is currently anticipating. So some of the rate reaction and the big rise in yields you're seeing is the need for the market to sort of expand the cone of uncertainty, if you will. And here on the first slide, I'm just showing how the yields are rising generally across the board, even for the laggard ECB, where we're seeing European rates crawling a bit higher. I think the ECB moment of capitulation does lie out there over the horizon. In the meantime, we're seeing euro dollar crushed to new lows because U.S. rates have risen to the degree they have. But if you look at the full U.S. yield curve, you're seeing these big rises mostly concentrated at the front end of the curve. What the Fed is going to do this year and into next year, you still have these longer U.S. yields, fairly or not, you still have them relatively anchored. And as long as that is the case, I think that the dollar is going to have a difficult time running away to the upside. And in fact, starting to develop a longer term bearish view on the dollar. And I think basically what the Fed is up to here, and what central banks are up to here, is they're going to keep tightening policy until something breaks. We're seeing some minor breaks here. We've seen a pretty decent break in the equity market, but this is not by any means a severe break just yet. And this chart here on this slide merely shows that there's almost a mechanical effect of when the Fed reduces its balance sheet side, that's the blue line with the axis on the right, it tends to correlate with the S&P 500. And when it doesn't, it's because something else is afoot. And that would be, for example, Trump tax cuts, which is a massive supply side tax cut that saw revaluation of equities without the Fed needing to do anything. And then you saw the Powell pivot, in which they well, actually, that does correlate there, but that does just wanted to highlight what happened there. They both, Powell both cut rates and started re-expanding the balance sheet. And that was even before the pandemic outbreak. So mechanically speaking, with the balance sheet expansion, screeching to a halt here into early March, and even reversing because we have a Fed that wants to also signal that they're going to be doing quantitative tightening, that is actually reducing their balance sheet and letting those assets roll off rather than rolling them over into new treasuries, for example, new MBS. That is going to put pressure on risk appetite. Now, we are looking at concerns on the fiscal side with a fiscal outlook where we're not seeing stimulus checks being dropped into the economy, all this crazy fuel that was added to the fire during the pandemic months. This stopped around April of last year, but there are other residual things that can come about. These are also feeding inflation, especially in the food space. Top right here, that chart is showing the degree to which basic food payments via this SNAP program, which is sort of the old, it used to be called food stamps, but now it's called supplemental nutrition, something or other benefits. These were increased by at the stroke of a pen on the order of let's call it 50% ish from pre-pandemic levels. And of course, that has been a driver of CPI food inflation. You can see that on the bottom. You're also seeing earnings running higher. You have the tightest job market in modern history in the US. So there are some offsets to the fact that there is a fiscal cliff, that we will need to see a little bit of lending and the credit cycle coming in here to offset some of that. But it's going to make for a very dynamic environment for the economy in this year. Now, one indicator to watch as we look ahead is the Fed's repo facility. That's the black line here. It's up to $1.6 trillion. This is essentially a kind of stored QE. You can see how that expanded as the US Treasury reduced its massive arsenal that it had built up during the pandemic in case it needed to spend to support the economy. That account was wound down due to various statutory reasons. It has expanded here a little bit in January. This is a seasonal thing. It'll drop again in February and March. But that is how much the Fed has to play with, if you will, as it considers reducing its balance sheet. $1.6 trillion that was not even there before for them to reduce even after they've stopped expanding their balance sheet. These are effectively securities that they bought under QE and are lending back out because the demand for that liquidity is so high. Also watching a couple of other things as we watch the dollar. And you can see that U.S. real rates here in black, this is the 10-year real rates, and this is relative to market assessment of forward yields, not the actual CPI, which is very, very high, latest print being at 7%. But real yields, even by these measures, are very, very low. It should be quite negative for the US dollar. We also have a current account that is turning viciously lower. US oil output is lower than it was in the years prior to the pandemic. US demand has rocketed higher from stimulus. All this needs to be offset by foreign capital coming into the US. Does that foreign capital want to come in at these highly negative real interest rates to purchase treasuries as the Fed is unwinding its balance sheet? Highly doubtful, and one of the longer term dollar negatives. One thing that has held up the dollar here this year, of course, is not only the Fed becoming more credible, showing its intention to hike rates, but it also upsets asset markets. That tends to upset liquidity. People are scrambling for dollars. So you see something like our global risk indicator flashing red. It was far worse last year, briefly during the Omicron meltdown. So far, a lot of this is merely linked to equity market volatility. So we haven't seen the heavy artillery, if you will, in financial conditions coming on board yet. Things like credit spreads still very, very compressed. They've only very slightly picked up. Just for an example, back in late 2018, credit spreads had to move from where they were at the beginning of October that year when U.S. 10-year yields were peaking out above 3%. They rose by about 50% back then over the next 3 months as the equity market corrected badly. We've not even gotten to the levels where we started in that episode back in 2018. So until those types of measures and, for example, longer U.S. yields head higher, I'm wondering if the market may sort of find its feet a little bit here in this quarter until, again, those longer yields and credit spreads and things like that become less anchored. All right, looking broadly at FX trends, we see that the top line here, the G10 plus the Chinese renminbi, or at least the offshore tradable version of that. China maintaining a very strong currency level, and I think that'll continue to be the case against the U.S. dollar and against and maybe more broadly speaking, as long as commodity prices are elevated, it does have the largest commodity import bill in the world. But as we move forward and China is easing, I'm wondering if the Chinese renminbi could ease off versus especially commodity currencies and the broader market, if not so much the U.S. dollar. And we see some of the weaklings here being the less liquid currencies that don't have any sort of commodity angle. Things like the New Zealand dollar does have a commodity angle, but more linked to food rather than metals and otherwise. And the Swedish krona, which has zero commodity angle, has really been left out in the cold here. One of the major valuation extremes, and I've talked about the theme being for much of the first half of 2022 being about currencies that have reached remarkable extremes, whether in weakness or in strength, mean reverting. The two most stretched examples relative to one another are the Japanese yen, which is in red here, and this is a broad measure of the Japanese yen relative to and adjusted to a CPI, versus the renminbi, which is at its multi-year highs. The last time we were at these stretched levels was when China re-engineered its exchange rate regime, and we saw a massive move there in relative terms. And I think the Japanese yen, despite it being sensitive to yields, what about real yields? The Japanese CPI has not responded the way we've seen CPI moving elsewhere. It is extremely cheap in relative terms. China is set to ease. I think we could see this being a major theme in 2022 as China moves to address some of the imbalances in its economy and the risks from all of the crackdowns it's seen, et cetera, real estate sector and otherwise, and the easing that will be needed to compensate for that, provide new credit to other areas of the economy, and get the economy moving forward again. Here you can see emerging market performance over the last 3 months, the top bar for each currency, and then over the last 12 months, the bottom bar for each currency adjusted for carry. The Turkish lira is an outlier. It's not a currency I would touch because this is a very experimental, strange new regime that Erdogan is trying to float with this odd deposit insurance idea. We'll see how it plays out. Of course, the currency is very cheap, but I think that at this point, the lira needs some sort of external savior to prop that up. Elsewhere, I think commodity-linked currencies are very interesting. The ruble has a massive discount because of the uncertainty over Ukraine. I'm sure it's justified now. I dare not say what is going to happen on that front, but if things do smooth out there, the ruble is very cheap, is very credible on the real interest rate front with its moves to constantly get the policy rate towards and even above inflation. Similarly, the case, I think, for something like the Brazilian real, medium term, and even the South African rand, where we're seeing some interesting policy moves. As long as they steer away from things that are getting fiscally risky, there's some circulation of universal basic income, etc. Also, like the Mexican peso, on the idea of supply chain diversification away from Asia for the North American market. I'm rushing through a little bit here, but I just want to get to the basic summary of what we're looking for. Essentially, the Fed is going to continue to hike until something breaks, and then it'll be forced to slow down relative to real interest rates. Dollar can only go so high. Real U.S. interest rates can only go so high before you trigger something that requires them to stop. So I don't know where that level is, but it's not a lot higher in my view. The dollar peak. Real credibility longer term comes at too high a price. And I think the Fed will eventually lag, especially the more credible central banks out there. The euro and the Japanese yen, there's a capitulation moment coming at some point out there for the ECB and or the Fed breaks something and has to retreat. So I think euro dollar is getting close to its lows, and 110 could be there, maybe a little bit lower, but we are looking for upside for the year. Similar case for dollar yen. I already showed you the valuation extremes there relative to the Chinese renminbi. Australian dollar, a potential star among G10 commodity FX, both on the metals intensity of the green transformation. There's even a nuclear angle on some of the resources in Australia. You have China stimulating. You have an Australia that has moved into a trade surplus from a long, decades of being a trade deficit and current account deficit country. They're really rebounding rapidly out of this COVID situation where they had the extreme lockdowns. I think Australia is an interesting story. NOK I like on oil. Swedish krona, I like on valuation, especially once the euro stops leading to the downside. And once the ECB capitulates, that allows the Riksbank to normalize to some degree as well. And I've already expressed a couple of emerging market views. I think it's going to be a very dynamic year for FX. Again, the dollars, if as Ola said, the strongest cure for high oil prices is high oil prices. Well, the strongest cure for a high dollar is a high dollar. It becomes too painful too quickly for the global economy. So I'll be looking for reasons to sell it, if not right here in the very tactical, the tactical time frame. All right, I will now hand it over to you, Chris, for some thoughts on macro.
Thank you. I hope you see my slides. So I will focus mostly on the macroeconomic side of the situation, and especially with a focus on the European Union. We have seen in the past few months that the European Union was facing a huge energy crisis. And I want to focus, look back a little bit what has happened over the past few years. Basically, the European Union energy policy was first, less consumption. Second, you will pay less at the end of the day. And third point, less pollution. What has happened actually, and we have seen it very clearly over the past few months, actually the consumption remained more or less the same. You pay much more, much more, and at the end of the day, you have much more pollution. So in this chart, I think this is interesting because you see the evolution of electricity production between 2016 and 2021 in the European Union. And I think this chart clearly states that the European Union energy policy was unwise, has not been implemented the right way. You can see that at the end of the day, the production of electricity consumption has been much more dependent over the past few years from fossil fuels. The idea initially was to get away from fossil fuels, but if you look at very carefully at this chart, you see that basically Europe is nowadays much more dependent on natural gas imports. And as a matter of fact, and John has mentioned it with the situation in Ukraine and Russia, we are also much more dependent on gas import from Russia. On the top of that, we see that some countries, especially I'm thinking of Germany, they are keeping up coal plants. And of course, this is much more pollution. This is not really looking for decarbonization at the end. So the situation is completely different from what the European Union has mentioned in terms of target. Of course, this is a long-term target, decarbonization. It won't happen from one year to another, but we see that the path is not the right, clearly, for the European Union. And it was bright clear if you look at inflation, but we have mentioned initially and still mention it, but we consider at Saxo that inflation is structural. And it is also structural because of the energy policy that has been implemented in the European Union. We see that what has happened in terms of policy clearly means that at the end of the day, you will pay much more energy prices. This is not only one winter. Next winter, if we face the same situation, if we are still much more dependent from natural gas or any other fossil fuels, we will see that energy prices will keep increasing. So I think this is one of the situations that at the European Union level, they have not understood quite well. Basically, if we get back a few years before, I think there were two mistakes in terms of policy. Energy policy at the European Union level. The first one was to basically focus mostly on the promotion of intermittent renewables. The problem with that, typically with wind power, is that you cannot provide a constant supply of energy sources. So, of course, if you cannot provide this constant supply of energy sources, at one point you will be dependent from another energy sources. Basically, nowadays, this is natural gas. And natural gas is the clear winner of the green transition in the European Union. This is, clearly does not make sense at all. And on the top of that, at the same time, we had several countries, and we see that they start to rethink about it, but not all of them. Several countries decided to implement a closure of nuclear reactors. And not talking about what is the position, ideological position regarding nuclear power, but as a matter of fact, very pragmatically, if you want to have lower energy prices, you will need to be dependent in the coming years, probably from nuclear power, much more than you have been in the past. And we have seen that currently energy prices, electricity prices are skyrocketing at levels that we have never seen in the past. One of the latest producing price index that has been released was in Spain a few days ago, and it was at 35% year over year in December. 35%. Of course, at one point, companies cannot mitigate this risk, and of course, they will try as much as they can to pass on higher prices on to consumers, but not all of them can do that. And at one point, you cannot do it for so long. So we are in a situation where the way the European Union and member states, of course, decided to implement the green transition is inappropriate and basically leads to higher energy prices. This is what we have experienced over the past few months. And my belief is that this is what we will experience again next winter if we don't change in terms of direction. One of the best examples, I think, of this unwise energy policy is Germany, clearly, in my view. I could have talked about Belgium, because also Belgium has decided to close nuclear plants. But I think Germany is the best example, and the one we really see that the way that the green transition has been implemented does not bring actually any positive impact in terms of prices, but also in terms of lower pollution. Germany has decided to get out from nuclear powers quite early. Actually, it was 20 years ago. Most of the people consider that it was in 2011, but due to the Japanese catastrophe, nuclear catastrophe, Germany has decided to get out, phase out from nuclear power. But actually, this decision, which was shared by all the politicians in Germany, was taken at the beginning of the more or less 20 years ago. Of course, what is the situation 20 years after that this decision has been taken and then progressively implemented? We see that basically Germany is much more dependent on fossil energy. So this is what we get in terms of green transition. It is a total nonsense. And I think what is interesting is currently Germany is producing roughly 1/8 more COD than France on average. Basically because they are dependent on natural gas, but even dirty brown coal. So this is a very negative impact on pollution. But on the top of that, it's not facing higher energy prices, because what is very clear is that we see on the top of that, that there is a risk of supply shortage. Some studies show, especially for Germany, that they will need to build in the next 10 years, basically 50 new gas plants if they want to avoid supply shortage. This cannot happen. It won't happen. So what does that mean? So some countries might face supply shortage, even Germany, and of course, higher energy prices. This is not all negative. I will go quite fast because we don't have so much time, but of course, I have been very negative in the previous slide, but at the end of the day, I think there is some glimpse of hope. During the Christmas break, the European Commission has published what they call the taxonomy. The taxonomy is basically which kind of industry will be implemented as green investment. And especially there is all this debate regarding which kind of energy sources should be labeled as green investment. The European Commission considers that nuclear energy should be considered as a green electricity sources. Of course, there is a long roadmap, and you can see this roadmap. This is quite long and goes until 2024. As a matter of fact, some countries, especially Germany, Austria, are fighting against that. They don't want that the nuclear energy is part of the taxonomy. So there will be in the coming 4 months a lot of negotiation at the political level, and we should get an answer by June, July. But if they follow the roadmap of the European Union, the positive part is, of course, we might not avoid in the short term higher energy prices, probably some supply shortage in some countries, but at the end of the day, probably in 7 or 10 years, we could have much more nuclear energy as part of the energy mix in the European Union. So this is the only way to get a green transition. In terms of conclusion, I see mostly, due to this unwise energy policy in the European Union, I see mostly 3 implications. The first one is the macro implication. Of course, energy inflation, we clearly consider it will not disappear. Probably it will have a less strong impact in CPI in the coming months, mostly due to better weather conditions. But I clearly believe that since we cannot change the situation from one day to another, we will have again energy inflation coming back next winter. And on the top of that, inflation will be a nightmare also in the European Union, especially the Eurozone, due to the service component that might increase from spring. So we won't get right out from this inflation headache. Geopolitical implication, I already mentioned it. We are already structurally dependent from Russia. It will get worse in the coming years, especially because Norway, which is the European Union's second largest supplier, will reach its gas production peak in the coming years. On the political implication, I strongly doubt that we will see this kind of yellow vest movement spreading over Europe. I don't think so, because I think most European countries don't have this protest tradition like France. But as a matter of fact, it might lead to populism, abstention from voting, political extremism. So at the end of the day, what does that mean? This European Union unwise energy policy will lead to a more divided society. And that's it for the macro part. Thank you.
All right, let's open it up for the question and answer session. I think if your layout is like mine, you have a question bar on the right side. Already quite a few questions and comments in there. That's great. I think I'll put it over to you, Peter, first. I don't know if you explicitly mentioned the percentage of the S&P 500, for example, or the U.S. market. I don't know how you want to slice and dice it. That is in energy. I know you've mentioned that statistic before, but somebody's asking, is this the time to be or to have exposure in oil and gas stocks? You kind of answered that in your presentation already, but just give us a basic perspective on the percentage of the S&P or the U.S. market that is in the energy space relative to historical levels.
Yeah, so we went from the global energy sector, at least in the S&P 500, where we have data the longest way back. It went from 10% of the market being the fifth largest sector in 1995, excuse me, to the second largest sector by a small notch in June 2008, only surpassed by the information technology sector, and now it's 2.7%. I think it's close to being the smallest sector in the US, and it's a very small part of the overall market, a little bit more than in the MSI world, but it's not a lot. So yes, we think the tide is turning for energy. That will soon be tailwinds, and just if you look at the oil and gas majors right now, I mean their profitability, their free cash flow generation relative to their valuations obviously reflect the ESG mandates, but also investors nervous what comes after oil and gas. But I think the big X factor here, the unknown, is for how long do we need oil and gas, and for how long can they extract enormous amount of free cash flows? Because at one point they probably will have to crank up their investments. But the signal they're sending right now is that we need higher oil prices than $90 to really increase investments. So because as John said, as you said, John, over lunch, I mean, they don't want to make the same mistake as all these investments they did from 2008 to 2014 that turned out to be really having a negative return. So a long answer to a short question, but yes, you should be overweight energy. What should that overweight be? Well, if you, I think even a 5% to 10% range of your entire portfolio in energy stocks is already a huge excess portfolio rate relative to the market portfolio. But it's all about your temperament. The inflation is the X factor that could push it higher, because you need more than just an alphabet. You also need an inflation hedge, and that potentially could argue for an even higher weight.
I was also looking at another way to slice and dice it. What is an expensive energy price? Well, just look at the nominal U.S. GDP relative to 2011. The nominal U.S. GDP, so just how many dollars is the U.S. GDP, is 50% larger. So $100 oil is no longer what it was 10, 12 years ago, merely from that measure. I mean, we've maybe have 1% per year productivity increases at best. So we have to keep in mind that we need to constantly shift where our perceptions of the energy price and a fair price are. Stain, I don't know if you want to address the question I'm not sure I have the answer for that. We have this interesting sort of persistence in the market that we're sort of anchoring these longer-term Fed, so-called terminal rate, where the terminal rate, where the market sees that the Fed will only be able to get to for this rate hike cycle, seems pretty low around the 2% level, and of course the 10-year is anchored around, well, so far relatively anchored, at least below 2%. Yield curve continues to flatten. Do you think the market's misguided in that belief? Where do you think the Fed could potentially go? I mean, it just seems like all this Fed hawkishness gets piled into the front end of the yield curve for now. What do you see in terms of yield curve perspectives for the remainder of this, at least this quarter, maybe even beyond?
So the terminal rate right now for the market, whatever measurement you use, is 2%, as you rightly say. So basically, at 200 basis point, the market thinks that's where the dead load is too high to carry any higher nominal rates. The problem with that argument is that constitute, in rough terms, only a tightening of the monetary condition that is insufficient to deal with the inflation issue. So you have, on one hand, the fact that the economy has a limit to how much higher you can take the interest rate before you break the camel's back, and on the other hand, you have the fact that you actually need a much higher than that telegraph 2% ceiling to contain the inflation. So for my money, as long as we are in what we call a structural issue, so all of this is more to do with supply than demand, and that the forward-looking commodity and oil energy sector, which is pretty transparent in terms of the supply and demand for the next 12 months and even 24 months, things are getting worse. Ole's roll yield of 5%, in my opinion, will be 10% the same time next year, because between now and 12 months from now, nothing can really happen in terms of increasing capacity, and you could have geopolitical risks that can, take that level up immediately and certainly on the energy side. So the yield curve, and part of what people think about the Fed is that they want to, and I think that's indirectly a question, they want to maintain a yield curve which is steep, indicating that there is future growth and then there is, a process under control of inflation. But again, the Federal Reserve is already 9 to 12 months late to the party of just recognizing the inflation at risk. And while we do that, we have the most leveraged market ever in margin terms, in terms of retail participation. We have the highest saving rate relatively to the cycle that we've seen at this stage. And we have the highest inflation. So we already have 7% nominal CPI, and for practical reasons, the first quarter of 21 was not a high inflation base to compare with. For the next 2 months, we will have higher inflation rate coming in. So the next two meetings, Fed will be looking at more underemployment. Right now in the US, there are 10 million jobs available and 6 million people unemployed. That number and the disparity between those two will increase over the next 2 months. And on the inflationary side, it will be going up. So basically, the risk we have between now and March is that the market realize that 200 basis point as a ceiling is not enough. My personal ceiling sits north of 250 minimum and probably 300. So the way to think differently about this is that the market right now consensus says that inflation will come back to a corridor of 2 to 3% and stay there. My best case scenario is that we are in a corridor of 350 to 450 because of everything that you gentlemen has been talking about, and because the structural issue, the wage inflation, and the fact that we come from very high personal income. So the higher the personal income, the higher the fiscal boost we come from, the longer it takes to drag the economy down to the equilibrium rate or the long-term growth rate in terms of the economy. So this concept that the economy will slow enough to give additional demand will fall enough to offset the supply is wrong for two reasons. Because supply is not elastic, so supply will actually be stable to lower, and demand will be not coming down as much as the market expects. So I think that question itself, John, is one of the, in my interpretation only, but that's one of the wrong assumptions the market makes, that 200 basis points is the ceiling of the ability to use that. And remember, if we go above 200 or we reach the upper limit of say 250, then the dollar will take it on the chin, right? So if you think about the U.S. as a current account deficit country, there's two ways to finance this deficit because the saving rate is too small in the US. So you need foreign investors. Foreign investors will buy for one of two reasons: higher yield, which is what they do right now. But if there's a ceiling to that, let's call it 250. When we read the 200, 250 ceiling, then the currency needs to take it the full adjustment. So what is interesting for me, at least, and you are the expert on foreign exchange, but as the macro guy, as the allocator guy here, I am long the dollar until we reach exactly that point in the yield curve that is too high for the US to carry the debt. So the omen on financing the US deficit will be on a weaker dollar. So basically, the dollar will tell you when it's too much. It's the simple answer.
And in the scenario outlined there, you have a situation where inflation is far higher than where the Fed can take those yields. So even if it does go above 200 basis points, as you indicate, what if inflation is 300 or 400 basis points? You're still dealing with negative real rates. A key point there. And then somebody's asking, well, how can the dollar go down if the dollar is correlated to financial conditions? And I would say, well, the dollar is financial conditions to a degree, and those can only go so tight before accidents happen. But staying a little bit on the energy front, there's a number of questions, and I think one thing we need to emphasize, I don't know if Ole, you want to pick this up, or Christopher, or even Peter, this whole issue around nuclear, it's very difficult to put into a quarterly outlook because you have this clear path to nuclear if it is declared a CO2 neutral fuel, far more effective and energy dense than alternative energies. Yes, there's some traditional risks associated policy-wise with it, but the lead times are tremendous. This is not a quarterly outlook. This is a decadal outlook. Where are we supposed to move on the nuclear front? Is it in the miners? Is it in the investing in uranium itself? Is it in investing in energy companies? What are we supposed to do here?
Well, I'll start up with that. I think first of all, it is in the producers because there is already a relatively tight market in the uranium space. But as you say, John, it's a very long-term prospect. So looking for a very sudden big move in the uranium sector is not something you should look for. You should take that as a very long-term view, and it's quite clear to see that right now the nuclear is around 10% of the global energy input, whereas renewables are still down in the very low single digits. And in order to go the next 10%, it will be much faster and much quicker to do that via the nuclear route. The main thing is you can see from my gray beard is that I remember the times in the 70s where it's all about nuclear war and we're all learning how to hide in the basement for fear of something happening. So there's a general apathy against or resistance against nuclear power. But I think we just have to look a little bit beyond that. There's obviously been a few mishaps, Chernobyl, Fukushima, Three Mile Island. But if you look at the number of the millions of people dying from pollution, then that it is a clear route to take. But the main issues right now, politicians are still not getting the input from voters that they wanted. And the problem with voters is that they say, well, it's probably a good idea, but not in my back garden. So there's still a lot of issues that needs to be solved. But this is really the so-called low-hanging fruit in order to get a rapid acceleration away from fossil fuels.
Do you have anything to add on that front, Christopher, as the lone resident in the most pro-nuclear country, at least the traditionally heaviest nuclear country in terms of power, struggling there with decades-old plants that are struggling to stay in operation? Are there any new plants coming online in France anytime in the future?
Well, the thing is that nuclear power is a state-oriented thing in France, and we have seen over the past few days there was a big debate in France, especially with the listed company EDF that is taking control of all the nuclear plants in France. And this is a public listed company, and they have asked the company to sell energy at much lower prices than the market price to competitors in order just basically to avoid a supply shortage for some competitors on the market. And what we see is obviously for this kind of listed companies, and especially we have a lot of French investors usually have in their portfolio this kind of EDF company. This is a big loss for the company because they are losing a lot of money due to political involvement. I would say from the French side of the situation, usually nuclear power is too much politics. So even people, when they want to invest in this portfolio, at least in France, they are very careful because they know politicians can step in very fast, and they don't think all the time about the own good of the company, but they think for lower prices and at the end all the political implication. But the last thing is what I strongly believe is France is pushing forward, at least at the European Union level. I was talking about the taxonomy. They are strongly pushing forward in order to have nuclear power as part of the taxonomy. It won't solve all the issues because implementing new nuclear plants, even the new generation ones, it takes optimistically 7 or 10 years. So, and I am still very optimistic, it can take much longer. So of course it won't solve the energy crisis situation in the European Union from one day to another, but we need to think long term, and long term, clearly nuclear power, I strongly believe, is the right path to follow.
Okay, great. Thanks for that answer. Key perspectives there. Peter, there's a couple of questions on equities. One is it time to buy the dip? And I'm not sure what he means, the question on quote unquote clean tech stocks. And then there was another one from ERK. Are growth stocks dead in 2022? And maybe just explain in a 30-second fashion the linkage on growth stocks and the sensitivity to those longer yields. And especially he mentions the quality names. So what's your perspective on the growth stocks / quality names and clean tech stocks for this quarter / this year?
So there, very simplistically, the higher the equity valuation relative to future cash flow, the higher that valuation metric is, implicitly the higher the interest rate sensitivity is. So in other words, if the interest rates go up by 100 basis points at 1 percentage point on the 10-year, your discount rate goes up by 1 percentage point, and that, all things being equal, is having a higher impact on those with higher valuations. So if you go to the growth part of the equity market, I see it as a sort of a 3-layered structure. So you have in the top layer, the top tier 1 growth companies, you have for a large extent the mega caps. So Meta, the parent company of Facebook, Alphabet, the parent company of Google, Apple, Amazon, Nvidia, yada yada yada, Intel, Alibaba, all these major technology companies. All of these companies have very high return on invested capital. They have global distribution. They have very high market power in their various industries, which means they have bargain power against their suppliers. They have bargain power against their employees to a certain extent. And they are able to, in my view, they're more able to pass on rising input costs. That's also what you saw in the 70s. The whole reason why Warren Buffett fell in love with companies with a wide moat or a brand is exactly a spin-off of that, basically. Then you have the tier 2, which are technology companies that are growing, but with not as high return on invested capital. They're more vulnerable. If they have high valuation, they're more vulnerable to interest rate sensitivity. And then you have the tier 3 layer, which is basically what we call the bubble stocks. So stocks with insanely high equity valuations and zero profit expectations in the next 1 or 2 years. That tier 3 level is going to be hit significantly hard. And I think there is an acceleration. There's a curve as you go from one tier to the next, where I think they will all be hit, but the tier 3 and tier 2 will be disproportionately harder hit than the tier 1. I hope that sort of explain things. So I think you will more quickly get to a point where there's a lot of value in technology stocks for the ones that have the high return on invested capital, the one that have the highest quality. In terms of clean tech, we're sort of experiencing the third, potentially the next collapse of green technology. Not in the technology itself, but the inflated equity valuation. So we had a collapse in green technology stocks during the great financial crisis, and then they have staged a comeback, and we're probably living through another version of that. And it's driven by that we got these very high equity valuation, which made them very sensitive to interest rates. problem being that compared to a classic bubble stock, which is a digital company, the green transformation stocks, the clean tech companies, they operate in the physical world, so they spend much more debt capital in their capital structure, so they get a double whammy on their cost of capital from a rise in interest rates. So that makes that part of the market more vulnerable. And we have said for over a year now that you have to distinguish between high quality and junk in this clean tech part of the market. I think there are some of the names. Obviously, I can't be too specific because otherwise compliance will be running. But there are names inside the clean tech that have come down to levels where I think you can begin to actually justify them in terms of equity valuation without having unreasonably insane expectations for the future, which were the problem over a year ago. So and you have a political tailwind. So I think it should you should be thinking about having that in the portfolio as well. But yeah, you have to be extremely selective.
All right, we're getting towards we're getting well past an hour here, so I want to limit how many more we can address your questions wise. Somebody asking about European price control is a really key question here. We've seen this in the UK as well. Governments limiting the pass on, as Christopher just addressed with the EDF in France, limiting the pass on of prices to the consumer. And obviously what this does, it keeps demand high, which means the price then can't correct to a lower level because people's behavior is not being altered by the higher prices. It ends up going straight to the fiscal. And I would argue, I don't know if you agree, Stain, also somebody with memory back to, or you don't have memory of this, but I'm sure you studied history, the disastrous price controls of the Nixon era, when both wages and prices he tried to control, and then also the controls they tried to do on pump prices in the U.S., which created these gas lines. Any thoughts on price controls? Maybe how likely do you see that, besides the obvious damage it does, how likely do you see this this aspect coming in as something that's to be debated and actually to be enacted beyond what we've already seen?
Of course, from a probability standpoint, Europe is more likely than US to enforce such a curfew. And you can actually argue you already have price control. In the case of France, Christopher just alluded to the fact that the French energy consumption is now subsidized. It's actually on the budget, so it's a fiscal expansion through energy, but it's effectively a price control. In most of the Northern European countries, you operate the energy policy based on the price of the energy, but then you add taxes and delivery and whatever onto it. So, depending on your definition of the price control, you already have price control in energy, not both in Europe, but also globally. But when you go to the broader concept of it, I mean, I think the lessons from the 1940s and 50s is that what the only thing you do is like you have a like a physical system where you contain energy inside the system, and when the system is breaks, of course, it releases more energy, and that's certainly what we saw in the 1940s after the Second World War, fiscal expansion where you had price control due to scarcity of again supply. But I'm a libertarian economist. I have to believe that the price control will work opposite of what the intention is. But more likely is it that we see, and go back to one of the core questions you've asked a few times, is that we go to this concept of YCC, yield curve control. Australia RBA tried that, and now we trade 150 basis points above that level that they designated as being the ceiling. So I think all practical experience, both on the downside of price and on the upside on prices, is almost destined to fail. But this being a political game and a narrative and a story that needs to be told to the voters, I'm pretty sure a number of people are doing, and I've like you have seen that a number of people in the space has introduced the concept of price control being likely, and including here is some of the major economists in Europe.
All right. I know we should wrap it up there. We have a few other questions hanging here. Energy prices be balanced future due to energy efficiency. I think what we're seeing is that alternative energy sources, solar and wind, at least, if those are the main categories of alternative energy, are not efficient. They're less dense, and I think that leads to higher energy costs being fed into the system. EM, I think on EM, I think again we're looking for. We have an initial Fed hawkishness that's feeding into a stronger dollar. We see a structurally lower dollar further down the road as we see the Fed lagging where interest rates or where yields and inflation. Sorry, Fed yields rises lagging where inflation is going. So even though their policy is tightening, it's not tightening in real terms beyond a certain point. So I think the impact on EM will fizzle beyond. We'll probably see some market volatility events this year, which we'll see discounted EM at times. But just look at this recent little episode here and see how well a currency like the South African rand has done. I think it's very different from what we would have seen in the past. So I think we're already seeing a less feed through into this kind of the traditional types of market reactions than we have seen in the past. I think, do we want to wrap it off here or wrap it up here? I think we'll do that since we've gone on here 75 minutes. We thank you for joining, and we'll, of course, be back next time around. Same format with this new tool here as we look at our Q2 outlook, and it'll be less than a quarter this time because we tend to roll these out. Q1 comes out in January because of the whole holiday season. The Q2 will be out, I believe, right around the very beginning of the quarter. So we'll be back in less than 2.5 months' time with our Q2 outlook. So stay tuned for that. Again, thanks for joining. Thanks so much for your many questions. Sorry to those we didn't get to. But you can always look to follow up on those in the future. All the best out there. Take care on behalf of the team. It's been a great session. Thank you all.